The dollar, the euro, the yen, all just pieces of paper. Yet one buys you a house, another buys you a coffee. Why? Because currency value isn't about the paper, it's about power. Every rise and fall of a currency decides who gets rich, who goes broke, and which nation controls the world economy. Today you'll learn how money truly moves, who manipulates it, who benefits from it, and how you can use this knowledge to protect and multiply your own wealth. Because in the currency game, ignorance isn't an excuse, it's a tax. Chapter 1. Money has no value until we give it one. Let's start with a truth most people never stop to think about. Money isn't real, not in the way we think it is. The dollars in your wallet, the euros in your bank account, the digital balance you see on your screen every morning, none of it has any intrinsic value. Money only has value because we agree it does. It's not backed by gold anymore. It's backed by trust, and that changes everything. Once upon a time, money was a claim on something real. A dollar meant gold in a vault. You could walk into a bank, hand over your paper, and receive a fixed amount of gold in return. That was the gold standard, a system that forced governments to stay disciplined because money represented real value. But that system is gone. In 1971, the United States officially ended the convertibility of the dollar into gold. Other nations followed. And just like that, the link between money and real assets was severed. From that moment forward, money became fiat. Fiat simply means by decree. The value of your money exists because a government says it does. And because you and I believe that decree, money isn't backed by gold anymore. It's backed by trust. Here's what that means for your wealth. When money was tied to gold, its supply was limited. Governments couldn't print too much without devaluing the currency. But fiat currency? It has no ceiling. Central banks can create trillions overnight with a few keystrokes. And when they do, your purchasing power quietly erodes. You feel it at the gas station. You feel it at the grocery store. You feel it when the same paycheck buys less each year. Inflation isn't an accident. It's built into the system. The money supply grows, but your wallet doesn't. That's why understanding the real nature of money is the first step toward building wealth. Because if you think money is value, you'll keep chasing it. But if you understand money as a tool, you'll start controlling it. Let's be clear, money itself doesn't make you rich. Money is a medium. Wealth is created through ownership. Say that again to yourself. Wealth isn't earned, it's built. And it's built by acquiring assets that hold or increase their value, even when the currency around them weakens. Think of it this way. If you hold $100,000 in cash and inflation runs at 8%, you lose $8,000 of purchasing power in 1 year. But if that same $100,000 is invested in an asset, real estate, dividend stocks, a business, productive land that grows or produces cash flow, your money works for you. This is why the wealthy don't save in cash. They own assets. They understand the system. We're playing a trust game. When governments print more, the money you hold becomes less powerful. But the house you own, the shares of companies you hold, the land under your feet, those retain value because they are real. Money isn't backed by gold anymore, it's backed by trust. But assets are backed by reality. This is where most people get stuck. They confuse money with wealth. They think stacking cash equals security. But in a system built on trust, cash is only powerful when it moves, when it flows into something that multiplies. Cash flow is freedom, not the cash itself, the flow. Think about the last time you felt financially stressed. Maybe it was paying bills, watching prices rise, feeling like your paycheck never stretches far enough. That feeling doesn't come from a lack of money. It comes from a lack of control. The system is designed to reward those who understand the game and punish those who don't. You don't need more money. You need better moves. Because if the rules say the currency will lose value over time, then sitting on cash is like sitting on a melting ice cube. You have two choices: watch it melt, or turn that ice into a flowing river. Now let's go deeper into the psychology of money. When people say money is power, what they're really saying is money is belief. If tomorrow the world stopped believing in a currency, it would collapse overnight. History proves this. The German mark in the 1920s, the Zimbabwean dollar in the 2000s, the Venezuelan bolivar more recently. When trust disappears, paper turns to dust. But gold didn't lose trust. Real estate didn't lose trust. Productive businesses didn't lose trust. Because wealth isn't in the paper. Wealth is in what that paper controls. Money isn't backed by gold anymore. It's backed by trust. And trust can shift. That's why the smartest wealth builders tie their future to something that can be printed, inflated, or manipulated. They anchor their wealth in assets that hold value when trust shakes. Let's bring this home. If you want to build real, lasting wealth, your first mental shift must be this. Stop thinking like a saver. Start thinking like an owner. Savers lose to inflation. Owners ride it. When the government prints money, asset owners benefit. Why? Because the new money flows into assets. It raises their value. Your house goes up. Your stock portfolio grows. Your business appreciates. Meanwhile, the saver watches their buying power shrink. You don't beat the system by fighting it. You beat it by understanding it. Here's your practical move. Stop hoarding cash beyond what you need for emergencies. Identify real, productive assets that align with your goals. Build ownership. Slowly, deliberately, relentlessly. Let cash flow, not cash storage, drive your strategy. Because remember, wealth isn't earned, it's built. The system won't save you. Ownership will. Cash flow is freedom. Money isn't real value. It's a symbol of belief. When that belief weakens, the paper fades. But when you control assets, your wealth stands firm. That's the foundation of financial power. Not the paper, not the paycheck, but the ownership. You've just taken the first step, understanding what money truly is, and more importantly, what it isn't. If you can shift your perspective from chasing money to building wealth, you're already ahead of 90% of the world. Remember, money isn't backed by gold anymore, it's backed by trust. Trust can be broken, but assets endure. When you stop seeing money as value and start seeing it as a vehicle, you stop being a passenger in the economy and start becoming the driver. You've learned the truth about money's illusion. Now it's time to learn how to control it. Chapter 2. The Gold Standard. When money was weight, close your eyes for a second and imagine this: a world where every dollar, every pound, every franc, every yen actually meant something tangible, where your paper note wasn't just a promise, it was a claim on real gold. For more than a century, that was reality. Money wasn't belief, it was weight. If you held a $20 bill, you held the right to exchange it for gold, sitting in a vault. There was no debate, no inflation games, no printing sprees. Value was fixed, trust was anchored, because under the gold standard, currency had discipline. Let's break this down. The gold standard was simple, brutally simple. Each country fixed its currency to a specific amount of gold. $1 was worth 23.22 grains of gold. 1 British pound was worth 113 grains of gold. You could walk into a bank, hand over your paper, and walk out with real gold in your hand. The system wasn't built on promises. It was built on metal. Why? Because gold doesn't lie, gold doesn't print itself, gold doesn't bend to political pressure. It forces discipline. This was the genius of the gold standard. It anchored currency to something scarce, measurable, and real. Here's why that mattered. When your currency is tied to gold, the government can't just create more because it wants to. Every new dollar must be backed by actual gold reserves. That means money supply grows slowly, in line with real resources. That means prices remain stable. That means your savings retain their power. If you earned $100 in 1910, it held its weight. Literally, the purchasing power was steady because the money was steady. People trusted the system because the system was built on something solid. And this is where history turns, discipline has a price. When economies grow, governments face choices. They can either live within the limits of their gold, or they can break free and print to fuel expansion. World wars, industrial revolutions, social programs, economic booms. These things required speed, flexibility, political room to maneuver. Gold didn't give that. Gold forced them to say no, and governments hate saying no. So slowly, cracks formed in the gold standard. During crises, countries suspended convertibility. They printed more money than gold allowed. They promised to return to discipline later, but later never lasts forever. In 1933, the United States abandoned the domestic gold standard. In 1971, the final link between the dollar and gold was severed. Nixon closed the gold window, and just like that, the dollar stopped being weight and became trust. Money wasn't backed by gold anymore, it was backed by promises. Fiat was born. Let's pause here. Under the gold standard, money had hard limits. Under fiat, money has none. One forces discipline, the other invites temptation. Because when money is backed by gold, politicians can't print their way out of bad decisions. But when it's backed by trust, they can. And they do. Here's the lesson. The gold standard was stability. Fiat money is permission. Permission to print, permission to spend, permission to manipulate. When governments switched from gold to fiat, they didn't just change money, they changed the rules of the game. This is why you feel the sting of inflation today. This is why the price of everything keeps creeping up. This is why your paycheck seems to shrink even when the numbers don't. The system isn't broken. This is the system. Now, I want you to think like a wealth builder, not a spectator. Why do the wealthy rarely get crushed by inflation? Why does your rent rise while your salary stalls? Because they own assets. They understand that fiat money is designed to lose value over time. Under the gold standard, holding cash made sense. It held weight. But under fiat, holding cash is like holding sand. It slips. This is why wealth isn't earned, it's built. The game changed, and the winners are those who adapted. You don't need to go back to the gold standard to protect yourself. You just need to understand what it taught us. Gold forced governments to be disciplined. Now you must force yourself to be disciplined. Here's what that looks like in real terms. Don't trust the currency. Trust what holds value when the currency weakens. Real assets. Build ownership, not savings. Under gold, savings grew in strength. Under fiat, only ownership grows. Cash flow beats cash storage because inflation is silent. It eats what sits idle. Play offense, not defense. You can't outsave a system designed to devalue savings. The gold standard was like a strict teacher. It said, earn it, save it, respect it. Fiat money is like a reckless teenager. It says, print it, spend it, trust me. And yet, the wealthy don't panic. Because they don't need gold to anchor their lives. They build their own standard. They anchor their wealth in ownership, in assets that outlast trust, in cash flow that outpaces inflation. Remember, the system won't save you. Ownership will. Cash flow is freedom. Now let's talk strategy. If your wealth depends on currency, you're standing on a foundation of sand. But if your wealth depends on assets, you're standing on rock. What are those assets? Real estate that appreciates and cash flows. Dividend-paying stocks that grow with inflation. Productive businesses that create value. Commodities that hold value when trust shakes. These are the modern equivalents of gold in your vault. No matter what the currency does, real value remains. But make no mistake, discipline didn't die with the gold standard. It just moved from governments to individuals. Under the gold standard, governments were forced to be disciplined. Under fiat, you must choose to be. Because nobody is going to save your purchasing power for you. Not the central bank, not the market, not your boss. You save it through action, through intelligent allocation, through ownership. You don't need more money. You need better moves. The gold standard was never really about gold. It was about discipline, about limits, about value you could touch. Fiat removed the weight, but not the lesson. Because true wealth isn't in paper. It's in what you own. When you anchor your wealth in assets, you create your own standard, unshakable, unprintable, unstoppable. You've learned why the gold standard kept money honest. Now it is time to face the system we live in today and learn how to win inside it. Chapter 3. Fiat money. Confidence as collateral money has changed, not in theory, not in small ways, in its very foundation. Once it was backed by gold, then by silver. Now it's backed by something far more fragile: trust. Welcome to the fiat era, a world where the value of your money isn't tied to metal, it's tied to confidence. Fiat money means value is declared by government decree. It's worth what we say it's worth. Not because it's backed by gold, but because people believe it's backed by something strong enough to hold. That belief, that confidence, is the collateral. When Richard Nixon cut the gold cord in 1971, he didn't just change the US dollar, he rewrote the rules of the global economy. He turned money from a claim on value into a symbol of value, and that symbol only works when enough people believe in it. The $100 bill in your wallet has no gold behind it, no silver, no vault waiting to give you something tangible. It only has the full faith and credit of a government. And faith is a fragile thing. Let's make this real. If tomorrow people lost confidence in the US dollar, it would fall like a house of cards, not because the paper changed, but because the trust did. That's the nature of fiat. It's not weight, it's not metal, it's belief. And belief can be shaken, it can rise, it can collapse. This is why fiat money is a confidence game. But here's the hidden power in that. In a gold-backed system, governments had limits. In a fiat system, they have flexibility. They can print, they can stimulate, they can manipulate interest rates. They can expand or contract money supply to shape economies. This flexibility can stabilize or destabilize entire nations. And if you're going to build wealth in this system, you can't ignore that reality. Because fiat money is no longer about what's in a vault. It's about the strength of the nation behind the currency. This is why currencies rise and fall, why some stay strong and others spiral into hyperinflation. The US dollar, the euro, the yen, these remain powerful because people trust their governments, their central banks, their political systems. But history is filled with examples of fiat currencies collapsing when trust disappears. Zimbabwe, Venezuela, Weimar Germany, the paper didn't change, the confidence did. And when confidence dies, currency dies with it. Now, if you're serious about building wealth, you must stop treating fiat money like gold. It's not stable, it's not permanent, it's not immune to pressure. Fiat money is a tool, not a treasure. It's a bridge between where your wealth is and where your wealth should live. Because wealth isn't stored in cash, wealth is stored in ownership. Remember this line: wealth isn't earned, it's built. And fiat money is just the scaffolding. So how do you navigate a system built on confidence? You track the pulse of that confidence. In a gold standard system, all you had to track was metal reserves. Today, the new gold reserves are economic strength, political stability, and fiscal discipline. 3 core indicators matter. Inflation. Inflation reveals how fast your money is losing power. The higher the inflation, the weaker the trust in the currency. GDP growth. GDP shows whether the economy behind the currency is expanding or shrinking. Strong growth reinforces trust. Weak growth erodes it. Political stability. Markets follow certainty. Investors trust what they can predict. Political chaos shakes confidence. If you want to survive in a fiat world, you must learn to watch these 3 like a hawk. But watching isn't enough. Action builds wealth. Here's the strategy. When inflation runs high, don't hold cash. Move into assets that outpace inflation: real estate, equities, businesses, commodities. When GDP is strong and stable, take calculated risks. Productive economies reward capital deployment. When political stability weakens, hedge. Diversify geographically and by asset class. Don't let one system hold all your net worth. That's how wealth builders play in a fiat world. They don't react. They anticipate. Think about this for a moment. If gold was your anchor in the past, today your anchor must be your strategy. Gold forced governments to be disciplined. Fiat forces you to be disciplined, because no central bank is coming to protect your purchasing power. They'll protect their system, their agenda, their balance sheet, your wealth. That's on you. The system won't save you. Ownership will. And let's get real here. The middle class suffers the most under fiat. Why? Because they save in cash, they hold in banks, they trust the system. Meanwhile, the wealthy use the system. They buy assets. They leverage debt smartly. They own the cash-flowing machines that keep producing, while the currency shifts around them. When inflation rises, their assets rise too. When money loses value, their businesses adjust prices. They don't feel the storm. They ride it. Cash flow is freedom, not cash storage. Flow. There's another truth here. Fiat money rewards speed, because when trust shifts, value moves fast. Those who wait to see what happens lose purchasing power quietly. Those who position early ride the wave. That's why wealthy nations dominate global finance. Their currencies are trusted. And that's why wealthy individuals dominate within those nations. They use trust as a tool, not as a crutch. The average person saves. The wealthy allocate. You don't need more money. You need better moves. Let's simplify. Fiat is fragile. Fiat is flexible. Fiat is a tool. Don't worship it. Use it. Move it. Invest it. Because if you let your wealth sit in fiat too long, it won't sit still. It will shrink. And that shrinking isn't loud. It's quiet. It's slow. It is invisible. Until you wake up one day and realize your 100 doesn't buy what it used to. Inflation isn't a glitch. It's the cost of trust. The gold standard had metal as its anchor. Fiat money has confidence as its collateral, and confidence is like glass, strong when supported, shattered when shaken. Your job isn't to trust the system blindly. Your job is to build wealth that stands when confidence cracks. Track inflation, watch GDP, read political signals. But most of all, own assets that thrive no matter what the currency does. You've learned the power and fragility of fiat. Now it is time to learn the next step, how to position yourself when that confidence begins to shift. Chapter 4. Why Currencies Rise and Fall. Money is power, but here is the truth no one tells you. Money isn't just numbers on a screen. It is a global vote of confidence. Every currency on earth rises or falls for one simple reason. Money moves where it is respected, not where it is printed. Let's break this down. Every currency lives inside a marketplace, and just like a stock, a currency gets stronger when more people want to buy it. More demand means higher value. Less demand means weakness. This isn't theory. This is the daily engine of the global economy. Every second, governments, corporations, hedge funds, and individuals are buying and selling currencies. Trillions of dollars move across borders daily, but they don't move randomly. They follow strength. They follow trust. 1. The invisible hand of demand. Why do some currencies get stronger over time while others collapse? Because strong economies attract capital. Weak economies lose it. If investors believe a country is stable, productive, and growing, they buy its currency. If they believe it's corrupt, unstable, or printing too much money, they run. Demand pushes prices up. A flood of sellers drags prices down. This is why the US dollar became dominant. It wasn't magic. It was confidence. After World War II, the world saw the US as the safest and strongest economy. Money moved in, the dollar rose, and it stayed strong for decades. The same rule applies to every currency, big or small. Money moves where it's respected, not where it's printed. 2. The interest rate magnet. Interest rates are one of the most powerful forces behind currency movements. Think of interest rates like a magnet. High rates attract investors, low rates push them away. When a central bank raises interest rates, holding that currency becomes more profitable. Investors around the world shift their money to earn those higher returns. Demand rises, the currency strengthens. When rates fall, the opposite happens. The currency weakens because no one wants to hold something that pays little or nothing. You've seen this play out. When the US Federal Reserve hikes rates, the dollar usually surges. When it cuts, the dollar often dips. But here's the key. This isn't just economics, it's strategy. Smart investors ride these waves instead of fighting them. If you want to build wealth, pay attention to interest rate trends. They are not just numbers on a chart. They read the gravitational forces pulling currencies higher or lower. Money moves where it's respected, not where it's printed. 3. Inflation, the silent killer of currencies. Nothing destroys confidence faster than inflation. When a government prints more money without creating more value, it's like diluting wine with water. The flavor fades, the trust fades, the value fades. People don't want to hold a currency that's losing purchasing power, so they sell it. They exchange it for stronger currencies, gold or other assets. Demand collapses, prices follow. Look at Zimbabwe, look at Venezuela, look at Argentina. All different stories, same ending. When inflation gets out of control, people don't trust their money anymore. And when they stop trusting, they stop holding. That's when collapse happens. Inflation doesn't just destroy economies, it erases wealth. If you want to build wealth, don't ignore inflation. Understand it, track it, hedge against it. Money isn't loyal. It doesn't stay where it's being disrespected. 4. Trade balances, the currency flow. Another invisible force shaping currency values is trade. When a country exports more than it imports, foreign buyers have to buy its currency to pay for its goods. That demand strengthens the currency. When a country imports more than it exports, it has to sell its currency to buy others. That weakens it. This is why countries with strong manufacturing and export power, like Germany, Japan, and historically China, often have stronger currencies or trade surpluses that support their value. It's not politics, it's math. Every product that crosses a border also moves currency with it. Trade isn't just goods and services, it's money flow. Money moves where it's respected, not where it's printed. 5. The psychology of confidence. Currencies don't just rise or fall on numbers, they rise or fall on confidence. Confidence is invisible, but it's everything. A country can have decent numbers, but if the world doesn't trust its leadership, legal system, or stability, money leaves fast. That's why investors often prefer a strong but predictable economy over one with high returns but chaos. Because in money, trust is wealth. When investors believe their capital is safe, they hold. When they doubt, they run. That movement alone can build or break a currency overnight. This is why geopolitical stability, strong institutions, and credible monetary policy matter so much. It's not just about what you do, it's about what the world believes you will do. 6. How smart investors use currency trends. So how can this knowledge make you wealthier? Simple. Stop ignoring currency movements. Start reading them like a map. Currencies are not just for traders. They affect everything, from the price of oil to your grocery bill, from your travel costs to the value of your investments. If you invest globally, currency strength can either multiply your gains or eat them alive. Strategy matters. When a currency is strengthening, foreign assets become cheaper. When a currency is weakening, imported goods cost more. A rising dollar can pressure commodities. A falling dollar can boost them. Smart investors position themselves early, not emotionally, but strategically. They don't fear currency moves. They use them to build wealth, not lose it. 7. The core truth. Here's the lesson I want burned into your mind. Currencies don't rise and fall by accident. They respond to supply and demand. Interest rates, inflation, trade, confidence, these are the levers. When these forces align, a currency strengthens. When they crack, it falls. But deeper than all that, money follows respect. And the moment a government, a company, or an individual stops respecting money, it moves somewhere else. Money moves where it's respected, not where it's printed. 8. Your wealth play. For you, this isn't just theory, it's power. You don't control interest rates, you don't control inflation, but you control how you position yourself. You can build assets in stable currencies, diversify across strong economies, hedge against weak currencies. Stay informed, not emotional. Wealth isn't earned, it's built. And part of that building is understanding the invisible tide beneath everything. Currency flow. Because whether you realize it or not, every financial decision you make swims in that tide. When you respect money, you learn its language. And the language of currency is trust, strength, and flow. Don't just chase returns, follow respect. That's where the real wealth hides. Chapter 5. The Dollar Dominance, How America Won the Money War. Every war has its winners, but the most powerful war ever fought wasn't one with tanks or bullets, it was one with money, and the victor was clear, the United States of America. Today, more than 80% of global trade transactions are settled in US dollars. Nearly 60% of central bank reserves around the world are held in USD. Oil, commodities, global debt, even wars, all of it runs on one currency. This didn't happen by accident, it happened by strategy. The post-war opportunity. After World War II, most of the world lay in ruins. Europe was shattered, Japan was broken, but the United States, its factories were intact, its military was unmatched, its economy was thriving. This gave America something priceless: leverage. In July 1944, 44 nations gathered at a small hotel in Bretton Woods, New Hampshire. They needed a new global financial system to rebuild the world, a system that would create stability, trust, and growth. America stepped up. The US had the largest gold reserves in the world, over 2/3 of the planet's gold. So they offered a deal: peg every currency to the US dollar, and peg the dollar to gold at $35 per ounce. It was genius. The dollar became as good as gold. And just like that, the US dollar became the world's reserve currency. Wealth isn't earned, it's built. And America built a system where every global transaction flowed through its hands. The power of the reserve currency. What does it mean to hold the world's reserve currency? It means the world needs your money to function. Every time a country trades internationally, they don't use their own currencies. They convert into dollars first. This creates permanent demand for USD. Permanent demand means endless printing power. While other nations have to earn or borrow foreign reserves, the US can simply print the very thing the world needs. It's like owning the casino. The house always wins. But the brilliance of America's financial power isn't just in economics. It's in how they tied money to energy. The petrodollar revolution. In 1971, something massive happened. President Richard Nixon ended the gold standard. The dollar was no longer backed by gold. Many expected the dollar to collapse, but America wasn't about to lose its throne. 2 years later, they made their next master move. They struck a deal with Saudi Arabia, the world's largest oil producer. The deal was simple but revolutionary. All oil sold internationally would be priced and settled in US dollars. In return, the US offered military protection and strategic alliances. This was the birth of the petrodollar system, and it changed everything. Because oil isn't just another commodity, it's the lifeblood of the global economy. Every country needs energy, every country needs oil, and if you need oil, you need US dollars. This forced nations to stockpile USD to buy energy. They stored those dollars in US banks, they bought US government bonds, and just like that, the dollar stayed at the center of the global financial system. Military, energy, and trade. The triple pillar dollar dominance rests on three unshakable pillars: military power, energy control, and trade dominance. Military power. The US military isn't just about defense, it's about protecting the financial empire. US bases circle the globe. Trade routes, oil shipping lanes, and key economic choke points are secured by American force projection. Energy control. By tying oil to the dollar, the US turned energy into a currency anchor. Even if gold was gone, oil replaced it as the new standard of trust. Trade dominance. US corporations, technology, and financial markets dominate global commerce. If you want to do business globally, the dollar is your ticket. The result? The dollar became untouchable. The privilege of printing. Here's what most people don't realize. Every time the US prints dollars, the world absorbs the inflation. Because USD isn't just for America, it's for everyone. Other countries must work, export, or borrow to get dollars. The US can print them. This is called exorbitant privilege. And it gives America a unique advantage no other nation has. This is why the US can run massive deficits and still remain stable. It's why recessions hit other countries harder than they hit America. Because America doesn't just play the game, it built the game. Global dependence today, the dollar is the default setting of the global economy. International loans are in dollars, oil contracts are in dollars, SWIFT payment systems run through US control. This gives America enormous geopolitical power. If the US wants to sanction a country, they don't need armies. They can cut them off from the dollar. It's like pulling the plug from life support. That's how powerful currency dominance is. The system won't save you. Ownership will. And the US owns the system. Challenges to the throne. Of course, no empire lasts forever. China is pushing the yuan. The EU has the euro. Crypto and CBDCs are rising, but none of them, not yet, can match the scale of the dollar's network. It's not just about currency strength. It's about trust, infrastructure, and military backing. And trust is hard to replicate. That's why, even in global crises, investors run to the dollar, not away from it. The investor's play. What does this mean for you as an investor? It means you must understand one thing clearly. Money moves where it's respected, not where it's printed. Capital respects the dollar because it's liquid, stable, and backed by global demand. That's why the world's wealthiest individuals and institutions hold US dollar assets, treasury bonds, real estate, equities. When the world shakes, the dollar stands firm. This doesn't mean the dollar is perfect. It means it's powerful, and power is predictable. Predictability is where wealth is built. You don't need more money. You need better moves. Strategic investors position themselves where the current flows, not against it. And right now, the current still flows through the US dollar. Final thought. The US didn't win the money war by accident. It won it with strategy, leverage, and control. While others rebuilt their cities, America built a financial empire. That empire still dominates today. Wealth isn't earned, it's built. And America built the system everyone else must play in. But history shows no empire is eternal. The smart investor doesn't wait for the tide to turn. They prepare for when it does. You've learned why the dollar dominates the world. Now it's time to understand what happens when that trust is broken. Chapter 6. When confidence crashes, currency collapses, money is only as strong as the trust that backs it. When that trust disappears, everything else follows. Currencies don't collapse because they run out of paper. They collapse because people stop believing in what that paper represents. This is the invisible line every economy walks. And when it's crossed, wealth vanishes at the speed of panic. You don't lose money in inflation. You lose trust in the currency that represents it. The fragile foundation of every currency. Every currency, no matter how powerful, rests on one thing: confidence. Not gold, not oil, not military power alone. Confidence. If people believe a currency will hold its value tomorrow, they use it today. If they don't, they run. Trust is the glue of every monetary system. Once it weakens, everything else, prices, wages, savings, investments, begins to unravel. This is why financial collapses always follow the same pattern: slow at first, then suddenly, all at once. The spark. Broken promises. Currency collapses usually start with a simple lie. A government promises more than it can deliver. It might be printing to fund wars, printing to pay off debts, printing to appease a restless population. But here's the rule of money. You can't print trust. When governments create money without creating real value behind it, the system fractures. The currency inflates. The people notice. And confidence begins to bleed out of the system. Wealth isn't earned, it's built. But when the foundation is fake, wealth rots from within. Historical warning signs. Let's look at history's most brutal lessons. Weimar Germany, 1920s. After World War I, Germany printed money to pay reparations. Prices doubled every few days. People carried cash in wheelbarrows. Workers were paid twice a day so they could rush to spend their wages before they became worthless. Zimbabwe, 2000s. Once one of Africa's richest nations, it printed to cover massive deficits. Inflation hit 79.6 billion%. $1 was worth trillions of Zimbabwean dollars. Venezuela, 2010s. Political chaos and collapsing oil revenue triggered uncontrolled printing. Store shelves emptied. Ordinary people turned to dollars, gold, even bartering, because their currency was no longer trusted. Different countries, different times. Same story. Trust collapsed, currency followed. Hyperinflation, panic, in real time. Hyperinflation isn't just high prices. It's a psychological breaking point. When people believe tomorrow's money will be worthless, they stop saving. They stop investing. They start hoarding. They convert cash into anything that might hold value. Real estate, gold, foreign currency, even food. And the moment people rush to escape the currency, the collapse accelerates. That's what makes hyperinflation deadly. It's not just math. It's human behavior. Economies don't implode because the printing press runs out of ink. They implode because people run out of faith. The system won't save you. Ownership will. Capital flight, the silent killer. When confidence crashes, capital doesn't wait. It flees. Investors move their money into safer assets or foreign currencies. Businesses stop investing. Citizens scramble to protect what little they have left. This capital flight strangles the economy. The local currency weakens even more. Inflation turns into hyperinflation. This is the death spiral of trust. Once it starts, it's almost impossible to stop without severe economic pain. You don't need more money. You need better moves. And in a currency collapse, that means getting ahead of the panic. The psychological shift that saves wealth. Most people wait too long to act. They hope things will go back to normal. But hope is not a financial strategy. Wealth builders think differently. They watch confidence, not just charts. They ask, do people trust this currency? When trust weakens, they shift early into assets that hold real value. Real estate, commodities, precious metals, stronger foreign currencies, productive businesses. These aren't just investments, they're trust shelters. Cash flow is freedom, and in a collapsing currency, cash flow in stable assets is survival. How collapses unfold. To understand how fast confidence can evaporate, remember this. Currency collapses slowly, then all at once. Here's the usual timeline. Excessive money printing. Governments fund deficits with new currency. Rising inflation, prices climb as trust erodes. Capital flight, smart money moves out. Public panic. Ordinary people rush to spend or convert. Hyperinflation, the currency dies. This pattern has repeated from the Roman denarius to the Venezuelan bolivar. History doesn't change, only the names do. Wealth isn't earned, it's built. But if your foundation is on a dying currency, you're building on sand. The wealth strategy in a collapse. So what can you do when confidence crashes? 1. Get out of the currency early. Don't wait for headlines. Watch trust signals. Black market exchange rates, gold premiums, political instability. 2. Move into hard assets. Paper can be printed. Land can't. Gold can't. Productive businesses can't be inflated away. 3. Diversify globally. Strong wealth builders don't tie their entire future to one government's promises. 4. Build cash flow in stable currencies. Your income should survive even if your national currency doesn't. 5. Study history. Because the collapse of trust is always visible, long before it makes the news. The system won't save you. Ownership will. Understanding the real enemy. Here's the hard truth most people don't want to accept. Inflation isn't just numbers on a chart. It's a transfer of trust from your hands to the government's hands. Every new bill printed without value behind it steals purchasing power from your pocket, bit by bit, day by day. That's why wealthy nations collapse in silence before they collapse in headlines. Confidence erodes quietly. And then, suddenly, it's gone. But smart investors don't panic. They prepare. They understand that money is a belief system, and when belief fades, assets remain. Final thought. When confidence crashes, currency collapses. It has happened before. It will happen again. The question isn't if, it's when. The people who lose everything are the ones who believe their currency is invincible. The people who build wealth are the ones who prepare for its fall. Trust is the real currency, not paper. You don't lose money in inflation. You lose trust in the currency that represents it. Wealth isn't earned, it's built. And in times of crisis, wealth is built by those who move early. You've learned what happens when confidence dies. Now let's uncover who controls confidence in the first place. Chapter 7. The Hidden Hand. Central banks and currency control money doesn't move by accident. It moves because someone, somewhere, is pulling the strings. Behind every currency rise or fall, behind every inflation wave or interest rate swing, there's a quiet architect, not a politician, not a banker, a central bank. This is the hidden hand that shapes entire economies. And if you don't understand how it works, you're not playing the wealth game. You're being played by it. 1. The power. Nobody votes for let's start with something uncomfortable but true. Central banks have more control over your wealth than your employer ever will. Why? Because they control the price of money itself. When central banks move, markets tremble. They can make borrowing cheap or expensive. They can make saving rewarding or pointless. They can make your currency stronger or weaker overnight. Their tools are invisible to most people, but those who understand them profit when others panic. Central banks use three main weapons: interest rates, bond purchases, aka quantitative easing or tightening, foreign reserves. Each of these moves shapes the value of your money and the direction of your economy. 2. Interest rates, the master lever. Interest rates are the steering wheel of modern economies. When central banks raise rates, borrowing becomes expensive. Businesses slow down, consumers cut spending. The currency strengthens because investors chase higher returns. When they lower rates, credit flows like water. Money gets cheaper, growth accelerates. The currency weakens, but economic activity surges. It's not magic, it's manipulated trust. A higher interest rate tells the world, we respect capital, invest here. A lower one says, we'll print to grow. Smart investors watch interest rate decisions the way traders watch stock earnings, because rates decide where money flows. And remember this line, money moves where it's respected, not where it's printed. 3. Bond purchases. Printing power, without a press. Now let's talk about a more subtle weapon, bond buying. When a central bank wants to stimulate the economy, it doesn't just cut rates, it buys government bonds. Why does that matter? Because when they buy bonds, they inject liquidity into the system. They flood banks with cash. They make borrowing even easier. On the flip side, when they sell bonds or stop buying, they tighten the flow. Credit shrinks. Liquidity dries up. Markets correct. This is the real printing press, not physical cash, but digital liquidity that fuels everything from real estate booms to stock market rallies. If interest rates are the steering wheel, bond purchases are the accelerator. 4. Foreign reserves, the currency shield. The third tool is foreign reserves. Every central bank keeps a stash of foreign currencies, like the US dollar or the euro, as a safety net. Why? Because when their own currency falls under pressure, they can buy it back using reserves. It's their way of defending their value. Think of it like a lifeguard jumping into the ocean to keep their currency from drowning. Countries with massive reserves, like China or Switzerland, can hold their currency stable even in storms. Countries with weak reserves, they're at the mercy of global markets. This is why some currencies crash overnight and others hold strong for decades. 5. Currency wars, the silent battle. Here's the part most people never see. Sometimes central banks don't just defend their currency, they attack others, silently. Welcome to currency wars. This happens when nations intentionally devalue their currency to make their exports cheaper. They want to sell more goods abroad. They want jobs. They want growth. But when one country devalues, others follow. Soon everyone's currency is weaker. That's why it's called a race to the bottom. Devaluation can help an economy short-term, but long-term it destroys trust. And without trust, currencies collapse. Here's the key phrase I want you to remember. The strongest economy doesn't win, the most strategic one does. This is not a moral game, it's a power game. Those who play it strategically win. 6. Psychological shifts for the wealth builder. Now, why does any of this matter to you? Because when central banks move, your purchasing power moves with them. And if you're not prepared, your wealth becomes collateral damage. Most people live as if interest rates are background noise. But the wealthy, they treat them like weather forecasts. They position their assets before the storm hits. When central banks cut rates, assets boom. Stocks, real estate, crypto, everything inflates. When they hike rates, the air comes out of the bubble. So stop reacting, start anticipating. You don't need to control the central bank, you just need to understand it. Wealth isn't earned, it's built. And part of building wealth is learning to read the invisible moves. 7. Action steps, how to protect and position yourself. Here's how smart wealth builders use this knowledge. Watch central bank meetings like earnings calls, the Federal Reserve, the ECB, the Bank of Japan. These meetings move markets. Track interest rate trends. If rates are rising, cash becomes king and debt gets dangerous. If rates are falling, assets rise. But inflation risk grows. Diversify across asset classes and currencies. Don't be trapped in one currency system. If your wealth lives in one place, so does your risk. Understand the lag. Central bank moves don't hit instantly. There's a delay. Use that time to move before the crowd does. Think strategy, not reaction. Don't fight the tide, surf it. 8. The wealth coach's closing word. You may not control the central bank, but you can control how exposed you are to its moves. When they pull the interest rate lever, they're moving your net worth. When they buy bonds, they're inflating your assets. When they wage currency wars, they're deciding the value of your labor. This is why financial literacy is power. Not just to make more money, but to protect the money you already have. Never forget, the strongest economy doesn't win. The most strategic one does. Wealth builders think strategically. They don't fear the hidden hand. They read it, anticipate it, and profit from it. You've now learned the playbook behind the curtain. But the game isn't over. It's global, and it's fast. You've just learned how central banks control currencies without ever stepping into the spotlight. But these moves don't happen in isolation. They ripple through the world's biggest, most invisible market. Next, we'll step into that arena. Chapter 8. Exchange rates. The world's largest market. You don't see. The largest market in the world isn't Wall Street. It isn't gold. It isn't Bitcoin. It's the foreign exchange market, or Forex. Every single day, over 7 trillion changes hands in this invisible arena. $7 trillion every day. That's more than the GDP of most nations combined. And here's the kicker. Most of it happens out of sight. No trading floor, no flashing screens, just a constant tug-of-war between currencies. This is the market that decides the value of your money internationally, your wealth, your purchasing power, your investments. And if you ignore it, you leave your financial future to chance. 1. Understanding the players. Who moves all this money? Central banks. The hidden hand we discussed in the last chapter. Global corporations, companies moving funds to pay for goods and services. Hedge funds and institutional traders, betting billions on the smallest market signals. Retail traders, people like you and me, small in comparison, but still part of the flow. Every participant has one goal: position themselves ahead of the moves that matter. But here's the lesson for the wealth builder. Cash flow is freedom, and in Forex, flow is power. Currencies don't just move because of interest rates or trade balances. They move because someone believes they will move. Rumors, geopolitical events, even social sentiment can shift billions in seconds. 2. The forces that move. Money. To understand Forex, you need to understand 3 key drivers: economic strength, GDP growth, employment numbers, industrial output. Strong economies attract capital, weak ones repel it. Political decisions, elections, policies, trade agreements. A single tweet from a world leader can send currencies soaring or plunging. Market psychology, fear and greed, speculation, collective belief. People often react before reality hits. This is why currencies are volatile, not chaotic, but hyper-responsive. The market doesn't just measure money, it measures confidence in money. 3. Central banks, the earnings calls of money. Remember what we said in the last chapter? Central bank meetings are like corporate earnings reports. But for nations, traders watch them closely. Every rate decision, every statement, every subtle hint matters. When a central bank signals tightening, currencies often strengthen immediately. When they signal easing, currencies may weaken, even before the action happens. If you want to play Forex as an investor, you don't guess. You anticipate. You track central bank communications like your most critical financial dashboard. Wealth isn't earned, it's built. And one of the fastest ways to build it is by understanding where capital will flow next. 4. The global tug-of-war Forex isn't just numbers. It's a story of nations competing for influence. When one currency strengthens, another weakens. Trade balances shift. Exports become more or less competitive. Investment moves. Jobs are created or lost. For example, a stronger dollar makes US imports cheaper, but exports less competitive. A weaker yen helps Japanese manufacturers sell abroad, but imports become more expensive. This constant tug-of-war creates opportunities for the prepared, and it reinforces a fundamental truth. The strongest economy doesn't win. The most strategic one does. Countries with clear strategy, reserves and timing dominate the Forex battlefield. Countries that react emotionally fall behind. 5. Why Forex matters to you. You might ask, I'm not trading currencies, why should I care? Because exchange rates touch everything: the price of imported goods, the value of your investments in foreign markets, the returns on international savings, the cost of traveling abroad. Even your local economy responds to global currency moves. If the dollar rises, foreign competitors' products may become cheaper. If the dollar falls, your local prices can spike. You don't need to be a trader to be affected, but the wealth builder watches the currents, even if they don't swim in them directly. Cash flow is freedom, and knowing which direction currencies flow gives you financial foresight. 6. The strategy. Here's how to approach Forex strategically. Monitor central bank meetings: Fed, ECB, BOJ, PBOC. These are the pulse points. Track macroeconomic data: GDP growth, inflation, employment. Strong numbers attract capital, weak numbers repel it. Observe political stability: elections, trade deals, sanctions, uncertainty, volatility. Watch market psychology: rumors and speculation move markets faster than facts. Anticipate crowd reactions. Diversify currency exposure. Don't bet all your wealth on one currency. Spread across stable and strategic currencies. This isn't gambling, this is positioning. You don't need more money, you need better moves. 7. The psychological edge. Forex teaches one core principle: money flows where it's respected, not where it's printed. The market is always testing confidence, and confidence is fragile. The trader who anticipates market psychology rather than reacting to it wins. The investor who monitors currency flows rather than ignoring them protects wealth. The wealth builder who prepares for shifts rather than panicking thrives. This is the hidden game behind every price you pay and every investment you make. Wealth isn't earned, it's positioned, protected, and expanded. 8. Actionable steps for individual investors. Even if you're not a Forex trader, here's how to use this knowledge. Hold part of your assets in strong foreign currencies. It's insurance against domestic currency weakness. Invest in global equities or ETFs. Currency movements affect returns. Diversification hedges risk. Track currency-sensitive sectors. Exporters, importers, and multinational companies respond directly to exchange rate shifts. Stay informed on macro trends. A weak domestic currency may make foreign assets more expensive, but exports more profitable. Anticipate, don't react. Build systems to adjust your holdings before the crowd panics. Cash flow is freedom, and understanding Forex gives you global visibility, even if you never enter the market directly. 9. Final thought. The Forex market is massive. It moves trillions every single day. It reacts to every economic indicator, political move, and whisper of change. Most people never see it. Most people are blind to its power. But you've now seen behind the curtain. You understand the invisible currents that determine currency value, purchasing power, and financial opportunity. Remember, the strongest economy doesn't win, the most strategic one does. Money moves where it's respected, not where it's printed. This knowledge transforms perspective. It turns chaos into insight. It turns uncertainty into opportunity. You've learned how exchange rates shape the world and your wealth. Now it's time to step back and see the bigger picture. How currency strength and weakness translate into real economic power for nations and individuals alike. Chapter 9. Currency Power. Economic freedom money isn't just paper. It's power, not the kind you spend at a store. the kind you wield in economies, markets, and nations, and the value of that power depends entirely on currency strength. Because a strong currency doesn't just buy goods, it buys freedom, opportunity, and leverage. A weak currency takes those away. 1. Why currency strength matters. A strong currency is more than pride on a global stage. It's a magnet for investment. Investors chase stability. They want their money safe and growing. Strong currencies signal strength, discipline, security. When a nation's money is trusted, capital flows in, jobs are created, companies expand, infrastructure grows, economic freedom spreads from the top to the streets. Wealth isn't earned, it's built. And one of the first bricks in that foundation is control over your currency. 2. Strong currencies show global buying power. When a currency is strong, nations can buy anything on the global market. Oil from the Middle East, machinery from Germany, technology from Japan. The world prices its resources in currencies that are trusted. The US dollar dominates because confidence in it is unmatched. A strong currency is like a superpower in your pocket. It reduces the cost of imports. It cushions against inflation. It provides leverage in trade deals and international finance. Cash flow is freedom. And in a strong currency system, that freedom scales globally. 3. Weak currencies, the double-edged sword. Weak currencies are not always bad. In fact, they can help an economy grow exports. When your currency falls, your goods become cheaper for foreigners. Your companies gain an advantage. Jobs are created. Exports surge. But here's the flip side. Imports become expensive. Inflation rises. Consumers pay more for basic necessities. Weak currency is a tool, not a strategy. If mismanaged, it steals wealth instead of creating it. This is why balance is everything. Too strong, exports suffer. Too weak, purchasing power collapses. 4. The individual angle. It's not just nations. Your personal wealth is affected by currency strength too. Strong local currency. Your money travels further. Foreign investments become cheaper. Travel costs drop. Import prices stabilize. Weak local currency, the opposite. Overseas assets get expensive. Inflation erodes savings, financial freedom contracts. The lesson is clear. Whether you're a country or a person, control your currency or it will control you. You don't need more money. You need better moves to protect it. 5. Building personal currency power. How do you achieve it as an individual? Diversify your wealth internationally. Don't tie all your savings to one currency. Hold assets in multiple strong currencies to hedge risk. Invest in hard assets and productive businesses. Land, commodities, and revenue-generating enterprises hold value even when paper money falters. Monitor macroeconomic trends. Inflation, interest rates, GDP growth. These determine currency strength. Avoid overexposure to debt in weak currencies. Borrowing in a currency that might weaken can destroy wealth overnight. Think like a nation. Protect, diversify, and strategically deploy your resources. Economic freedom begins with strategic positioning. 6. Case study: USD versus emerging market currencies. The US dollar remains dominant because it's strong and trusted. Investors worldwide hold dollars. Global commodities are priced in dollars. US government debt is considered safe. Compare this to a country with a weak currency. Imports cost more. Capital flees to stronger currencies. Inflation eats away at savings. The difference is confidence. The difference is strategy. The difference is economic freedom. 7. Currency power as a national strategy. Strong nations understand that currency is an economic weapon. They maintain fiscal discipline. They balance trade. They control inflation. They build reserves to defend their money. This is why some nations can weather crises without collapsing. They've built strength before it's needed. Individuals can mirror this. The wealthy anticipate and protect their purchasing power before trouble strikes. The system won't save you. Ownership and foresight will. 8. The psychological principle. Currency strength is perception backed by reality. If people trust your money, it's strong. If people doubt it, it's weak. Trust drives capital. Capital drives growth. Growth drives freedom. Every investor, every trader, every citizen who ignores this principle leaves wealth on the table. Cash flow is freedom. Currency strength magnifies that freedom. Weakness constrains it. 9. Actionable steps to harness currency power for personal wealth. Hold a portion of assets in globally strong currencies, USD, CHF, or other stable currencies. Invest in diversified global markets, stocks, bonds, or ETFs in different economies. Protect purchasing power, monitor inflation and hedge with hard assets. Leverage knowledge over luck. Anticipate currency shifts. Position before the crowd. Think strategically. Treat your personal balance sheet like a central bank would. Defend your wealth, grow your influence, and control your economic freedom. 10. Final thought. Currency power equals economic freedom. Whether you are a nation controlling global trade or an individual building personal wealth, the principle is the same. Control your currency, or it will control you. Strong currencies attract investment, create jobs, and expand opportunities. Weak currencies can boost exports, but reduce living standards. Balance is everything. Wealth isn't earned, it's built. Cash flow is freedom, and freedom grows when your money holds its power everywhere it goes. You've now learned how nations and individuals alike gain power through currency. Next, we step into the future of money, where power is no longer printed, but programmed. Chapter 10. The Future of Money, from Paper to Digital Power. Money is evolving, faster than ever. What you know as cash, coins, or even bank deposits is becoming obsolete. The future isn't physical, it's digital, and if you don't understand this shift, you'll be left behind, financially, strategically, and globally. The future of money won't be printed, it'll be programmed. 1. From fiat to digital. Fiat money once gave governments full control. They could print it, regulate it, and declare its value. But digital currencies challenge that control. They don't just represent money, they operate as software. Central bank digital currencies, CBDCs, are government-issued digital money. They promise efficiency, transparency, and programmability. Cryptocurrencies, like Bitcoin or Ethereum, bypass governments entirely. They are decentralized, trustless, immutable. The power balance is shifting. Control over currency may soon depend on networks and code, not borders and central banks. 2. Why this matters. Consider the global implications. Trade. Digital currencies could settle international transactions instantly, without intermediaries. Inflation control. Programmable money could automate monetary policy. Financial inclusion. Billions without traditional banking could enter the system. For investors, this isn't theory, it's opportunity. The digital revolution democratizes financial power. It allows individuals, businesses, and even small nations to participate on equal footing. Cash flow is freedom. Digital money amplifies that freedom instantly and globally. 3. Network effect, the new reserve power. In the past, global reserve currencies were tied to strong nations. Military strength, trade dominance, natural resources. Tomorrow, the reserve could be a network, not a country. Why? Because networks scale differently. They operate globally. They are censorship-resistant. They are programmable. Bitcoin is a prime example. It's not controlled by any nation, yet it has become a store of value. Ethereum offers programmable money that can execute contracts automatically. The lesson is clear. Power in money is shifting from geography to technology. Wealth isn't earned, it's built. And building it now means understanding these new networks. 4. Programmable money and smart contracts. Digital money is programmable, meaning the money can follow rules automatically. For example, taxes can be deducted at the moment of transaction. Payments can be conditional on delivery of goods. Funds can be locked or released automatically. This is not science fiction. It's already happening. The future of finance is code-based. For investors, this is a psychological shift. Wealth will depend on your ability to navigate software-driven ecosystems, not just physical assets. You don't need more money, you need better moves. 5. The role of governments. Governments are aware. CBDCs are being tested in China, Europe, and the US. Why? Control. Governments want to retain influence in a digital world. CBDCs offer them the power to track transactions instantly, implement monetary policy with precision, combat money laundering and fraud efficiently. But there's risk. Overreach could limit personal freedom. Privacy may erode. The system could become invasive. The wise investor prepares for both possibilities, opportunity and risk. 6. Cryptocurrencies. Power to the people. While CBDCs centralize control, cryptocurrencies decentralize it. Bitcoin is finite. Only 21 million will ever exist. Ethereum allows programmable financial applications. Other altcoins offer specialized solutions for payments, identity, and smart contracts. The lesson: the future of money is flexible, transparent, and borderless. Individuals who understand this shift will have first-mover advantage. Those who ignore it will be at the mercy of a rapidly digitizing financial system. 7. Psychological shifts for wealth builders. Digital money requires a new mindset. Think in networks, not nations. Wealth now flows across borders instantly. Adapt to programmable finance. Money can move, lock, or multiply based on code. Prioritize security. Digital assets are vulnerable to hacking. Protect keys and wallets. Monitor adoption. The first movers in digital finance often capture disproportionate advantage. Anticipate policy changes. Governments will regulate, tax, and innovate. Stay ahead. Cash flow is freedom. Digital money expands that freedom globally. Those who embrace it early build generational wealth. 8. Actionable steps. How to position yourself for the digital money era. Educate yourself on blockchain technology. Understand networks, smart contracts, and tokenomics. Diversify holdings between fiat, digital, and hard assets. Don't rely solely on paper currency or crypto. Spread risk. Use programmable finance tools. Explore decentralized finance, DeFi platforms, yield farming, and automated protocols. Secure your digital identity and wallets. Cold storage, hardware wallets, and multi-signature solutions protect wealth. Monitor global adoption trends. CBDCs, crypto regulations, and network upgrades are early indicators of wealth opportunity. You don't need more money, you need better moves that anticipate the digital shift. 9. The wealth builder's closing thought. The transition is inevitable. Cash will not disappear overnight, but the future of money is digital, programmable, and borderless. Those who prepare now will control wealth on a new dimension. The principles remain. Build strategically. Protect your assets. Adapt to change faster than others. Use knowledge as leverage. The next global reserve may not be a country's currency. It could be a network, a protocol, or a blockchain ecosystem. The future of money won't be printed. It'll be programmed. Embrace it. Study it. Position yourself. Your financial freedom depends on it. You've journeyed from gold and fiat to global currencies and digital power. You've learned how money moves, who controls it, and how you can harness it. Now, the next step isn't theory, it's action. The real wealth builders are those who translate this knowledge into moves today. This concludes the exploration of money's past, present, and future. Your next move is to apply these principles relentlessly, building freedom that lasts generations. Different currencies have different values, not because one nation is smarter, but because one nation is trusted more. The dollar dominates because people believe in it. Lose that belief, and the dollar falls like any other. So stop thinking of money as a fixed thing. It's a living, breathing reflection of confidence, productivity, and power. For you, the lesson is clear. Build trust in your economy, your personal one. Earn more than you spend. Invest in assets that rise when currencies fall. Be the economy others believe in. Start today. Build your value, your currency, your power. Because in the global game of money, you're either setting the rate or being priced by it.